Okay, we're going to have a lesson on financial planning. So I believe we all know each other. So I'm Emin, just in case you don't know. And Jimmy's in the house. Thank you so much for joining us today. Standard disclaimer, make money, be happy, lose money, don't scold us. Okay, so today we're actually going to work on the spreadsheet. In the spreadsheet, you'll be able to do this thing, the goal setting, asset allocation, and milestone tracking. Now, before I actually go into the actual exercise, I just want to spend some time explaining to you this concept of creating wealth accumulation systems. Why this system, why this creating system will work. So of course, if you can recall, basically what is this system about? We actually have a structure for you to invest regularly. So one main part, we have these structures. Okay, the keyword here is invest regularly. Okay, in instrument that actually give you higher returns. And over time, okay, you will be able to snowball your wealth. Okay, why this will always work? It's actually based on a science, which is what we call the law of large numbers. Okay, law of large numbers. I finally figured out a very interesting way to explain this concept. Now, can someone please tell me if given a chance or given a choice, would you rather be the casino, we call them the house, or would you rather be the gambler? Okay, so let's say you get to choose. Okay, now you get to choose. Would you rather be the casino or would you rather be the gambler? Okay, Mikui said casino, Peichin said casino. Okay, I shall say casino. Okay, why you actually want to be the casino? Can someone actually please share now? How come you actually want to be the casino? Law of large numbers, okay. Thank you so much. Casino will always win. Okay, it's never about high. Okay, the casino will always win. The keyword here is the casino will always win. Casino will never lose. They will always win. Okay, why? Because they win by using science. Okay, they win by using science. They are not like gambler. Gambler have to win by using luck. Okay, whereas casino, the casino they actually win by using science. Okay, and the science they actually use is actually these two things. One is probability as per what Adam has actually mentioned. Okay, the other science they actually use this thing called the law of large numbers. Okay, so let me just explain this to you in detail. So hopefully you will find this very interesting. So this is a picture of American roulette. American roulette, as you can see here. Okay, let's focus. Okay, maybe let's focus on this picture. So if you actually look at it in detail, there is in total of 38 numbers here. 38 numbers. All of which 18 are black, 18 are red, and 2 are green. Okay, 18 black, 18 red, 2 are green. Okay, now I need you all to help me calculate to 1 decimal point. Calculate to 1 decimal point. So if let's say, for example, you bet black color. Okay, you bet a black color. What is your probability of winning the game? So of course, I'm question roller. You know, I just roll the ball and see where the ball lands. Now here's the question. There's 18 black, 18 red, and 2 green. If you actually bet black, what is your probability of winning the game? Can I just trouble you all to punch the numbers in the calculator? Okay, Edison said 0.47, Vivian said 47%. Okay, maybe I just wait for a few more answers. Okay, thank you so much, 47%. So basically the house, okay, for every game that casino design, you can see that, okay, the house will always has a higher probability of winning. Okay, the chance of winning is always higher. Like in this case, the chance that the house winning is actually 53%. Okay. And the other signs that they actually use here is this, as long as there is enough numbers, we call it a law of large numbers, which always happens. Okay, it's a science, it's not art. As long as there's enough numbers, okay, the outcome will always tend towards the probability. Which means to say, if let's say, for example, you play this 100 times, and let's assume that 100 times is equal to large numbers, 100 times, okay? So if you play 100 times, okay, what's going to happen is this, you are actually going to win 47 times, okay? You're actually going to lose 53 times. You're actually going to lose 53 times. So that's why net, okay, the casino will actually win 6 times, because he win 53, lose 47. Okay, net, you actually make money from that 6 times, 53 minus 47. Okay, so every time this game is actually played 100 times, he will confirm win 6 times. Okay, it's a science. It always happens this way. This is what we actually call the law of large numbers. Okay, so this is my point here. This is my point here. Okay, we can actually use science to actually win the investment game. Okay, we can actually use the exact same principle to actually win to win the investment game. So we just have to follow what the casino does. That actually the two things. Okay, number one here is this: every time we pick up a stock, every time we pick up an instrument, okay, we want to have the probability of this stock, this instrument making money for us is actually more than 50%. Okay, that's number one. Then number two, what do we have to do? We have to actually make sure the law of large number kicks in. Okay, that's why we have to buy regularly. Okay, buy different stocks at different time, or buy different instruments at different time. And once you hit the law of large numbers, okay, that's where you will always have more wins than losers, and you will always make money. Okay, so of course, from a professional perspective, we don't call that gambling, definitely. We actually call it portfolio management or diversification. Okay, so this is actually the concept of creating wealth accumulation systems. So we actually want to make money from investment using science. We are not here betting on our luck or using any art. No, it's pure science. Okay, every time we pick up a stock, every time I pick up a fund, okay, the chance of this instrument making money for more than 50%. And we just have to keep repeating the process. We buy month after month. We buy regularly. Okay, so over time, once the law of large number kick in, you will have more win than losers, and you will always make money. Okay, so do me a favor. If let's say you are okay with this concept, don't mind just help me type for 1 if you understand. If you have any questions, feel free to ask. I think this is actually quite important. This is actually quite important. This is actually what the whole concept is actually about. Of course, anybody has any questions, please ask. Okay, by the way, just a little trivial. In fact, I actually do a little bit of experiment with this concept, and so far it has worked well. Now, Toto, everybody know what Toto is. So Singapore national favorite. Now I think it's 6 choose 49. 6 numbers choose 49. Okay, but of course, to win the Toto, to win any prizes, okay, not the first prize, to win any prizes, anybody know what is the probability of winning any prize? What is the chance of winning any prize? That means $10 also considered win. Anybody know what's the probability? Or okay, Erin, I come to you later. Okay, what's the probability of winning the Toto any prize? Okay, $10 also considered win. Anybody know? Okay, how Toto work is the 49 choose 6 numbers. Okay, let's go to Singapore Pools. Okay, of course, I'm not encouraging you to gamble. I'm just using their concept and how to apply on investments. Okay, this one Toto. Okay, Toto. So it's 6 numbers, choose for 49 number, choose 6. Okay, the probability of winning any prize is actually 1 out of 52. Okay, $10 also win. Okay, $10 also consider win. So the probability of winning any prize for Toto, because for them, once you hit 3 numbers, is a win already. Oh, you hit 3 numbers, okay, you actually win $10. Oh, so I tried twice. I tried twice. I buy 52. I buy 52 of the Toto tickets. And true enough, every time I buy 52, I have 1 win. Okay, so I tried twice already. So I believe for Toto, the large number is just 52 tickets. So once I hit 52 tickets, I will at least have 1 winning ticket of 3 numbers. Okay, so my point here is this: it always happen. It always happen. This is a science. Once you hit the large numbers, the outcome will always tend towards the probability. Okay, y'all can try, but then of course I still lose money now, because now one Toto ticket is $1. So I buy 52 tickets is $52. I only win $10. Okay, but I do that for the sake of experiment. Of course, hopefully also win, but too bad never win a big prize. But that's what I mean by science. It always happen. Okay, so now that you all agree with this, so basically, you know, in all investments, we try to do 2 things. One is to increase the probability. Okay, the other one is, of course, to invest regularly so that we hit the large numbers. Okay, so this is what we're actually going to go through in subsequent lesson. Of course, some of you actually went through that. Like, for example, for stocks, we have a set of criteria. So very likely that if you actually follow the criteria closely, your probability will increase. Okay, and once every time you pick a stock more than 50%, you buy over time, yes, okay, very likely you have more winning stock than losing one. Okay, same for funds, same for fixed income, same for REITs. We have a set of process for you to just follow. Okay, very likely you follow this process. If you pick up something, I would not dare say that this 100% make money for you, but the probability is likely to be more than 50%. And over time, you build a portfolio, you will have more winning than losing. Okay, so let me just demonstrate. We go to sjax.com. Okay, there's actually this thing called the stock screener. So of course, not to worry, for those who have not gone through a stock course, we will actually do that in subsequent lesson. So what this stock screener does here is this: based on certain criteria, okay, they will filter out stocks that meet the criteria. Okay, so let's look at this thing called the 52 weeks price change. Let me click on that. So this is what happened here. There is 584 stocks that have price difference from 1 year ago. Okay, 52 weeks is 1 year. So 584 stocks, there's actually price difference from 1 year ago. So this period is a bit unique now, because now market is actually on quite a high. Okay, but what I want to show here is this. Okay, remember 584. Now, this is what happened here. If let's say, for example, I just randomly pick up a stock 1 year ago. Okay, if I just randomly pick up a stock 1 year ago, and you just randomly buy. Okay, so as you can see here, out of the 442 are making money today. 442 of the stocks are making money today. Now, can you please help me to calculate what is the probability that I just randomly close eyes, just pick up a stock from 584, and this stock is actually making money for me today? What is that probability? Can I just trouble someone to help me calculate, please? Okay, Edison said 75%. Anybody else? Okay, Erin 75%. 63%. Okay, let's see. Let's see. So it's basically you take 442 divide by 584. Okay, it should be 75%. 75%. Okay. 75%. Okay, of course, this period is a bit special because now the market is on a high compared to 1 year. So of course, when market is not at the high, at the middle or the low, you probably will be like less than 50%. Okay, now, this is what happened here. Instead of me randomly picking up a stock from the five, what I do here is this. I actually filter my stocks. I only pick up stocks with ROE of more than 15%. Okay, then I only pick up stock with net profit margin of more than 5%. This is the part I really hate. Okay, good. So instead of just randomly pick up stocks from 584, now I only pick up stocks from this 47. 47, and you can see out of this 47, 40 of them are actually in the money today. Okay, can now someone help me to calculate, please? What is the probability that, you know, if I randomly pick from that 47, okay, this stock is making money for me today? Can someone help me to calculate the probability, please? Stella said 85%. Thank you so much. Anybody else? Anybody else can share the calculation? So if I, instead of randomly picking from 584, now I randomly pick from 47, and out of which, okay, 40 are in the money today. So can someone tell me what's the probability that, you know, the stock I pick is actually making money for me today? 40 out of 47. Thank you so much. That's 85%. Let's again just confirm. Okay, you take 40 divide by 47 is actually equal to 85%. Okay, so you can see from a stock selection process, I can increase my probability of success. And that is the first thing that we do here. So every time when we actually pick a stock, pick a fund, we cannot pick at random. We want to have selection criteria like ROE, net profit margin, okay, certain criteria. What's the whole idea? The whole idea here is, okay, we make sure that our probability that this stock make money for us is actually more than 50%. Okay, more than 50%. And next, we do that on a monthly basis. We have the law of large number kick in, okay, and then the outcome will tend to a probability. So let's say, for example, on average, we are able to every time buy a stock, 70% of the chance make money for us. Once we actually buy over 100 times, okay, 70 stocks will make money for us, 30 stocks will lose money for us. Then net we will actually gain from 40 of the stocks as per what this slide is actually talking about. Okay, so diversify over different instruments over different time. So let's say we can increase probability of success to 70%. Okay, out of 100 purchases, 70 will make money, 30 will lose money. So 70 minus 30 net, we will make money from 40 stocks. Okay, and we will always win. You are just going to be like the casino of the stock markets. Okay, so this is the concept of creating wealth accumulation system. Why we actually have to do it this way? Why do we have to buy regularly? Okay, because we want to use science to make money, not art, not luck. Okay, I think there's some questions. Okay, Erin, how did I actually get 47% from the casino one? Then let me go back to that casino picture.
You mean, isn't it 18 divided by 58?
No, it's 18 divided by 38.
38?
Because there's only 38 numbers, ma.
Oh,
Total
sorry,
there's 38 numbers.
Oh, I
Yeah.
divided into 58. Sorry.
Yeah. So it's 47. So
Okay.
now you all know why. If you actually go casino, cannot play long. So if you actually go casino, you play long, okay, the probability is not aside, then you will confirm 100% lose. So you play American loaded, you play 100 times, okay, you will definitely lose 47 times. You'll definitely lose 53 times, and you only win 47 times. Then net you still lose 6 times to the house. Okay, hopefully, after understanding this, you wouldn't actually want to go gamble anymore. Okay, so this concept again. Anybody, any questions? Anyone, any questions? So I think this is actually quite important now. Hopefully you can stay here. So this is the reason why I don't go so much into trading. Okay, I don't go so much into, buy low, sell high, buy low, sell high, because that one, the element of science is very weak. Okay, in my personal opinion, I don't even think there is any science involved. It's a lot about luck. Okay, and how I define science is this. Okay, when it's a science, when you have the same process will always result in the same outcome. That's why I call it science. So luck or art is when the same process will always different outcome. Okay, and why I actually want to do this, because I'm actually using science, and once I have this process that confirm make money, okay, maybe not much, but I know that I will confirm make money. Okay, anybody has any questions, agree, disagree, comments? I think this is important. That's why I don't mind just spending a little bit of time here to make sure everybody get it.
Amy,
Yes.
you mentioned trading. Is it because trading is a bit like trying to second guess the highs and the lows? That's why it's akin to gambling?
Yeah, correct. There's no science to help you. Like for example, today you buy CapitaLand hoping to sell tomorrow. What process can you use to make sure that the price will go up?
Pray to God, I think.
So apparently, some of the traders believe in looking at charts. Looking at charts, but the charts is actually based on human behavior. So again, that one is not a science. Human behavior can change.
Okay.
Yeah. So whereas now I'm actually basing on the concept of probability, I'm basing on the concept of law of large numbers. So y'all can actually go and Google a law of large numbers. It's quite interesting. This is science. Of course, feel free to do some experiments. So let's say, for example, when you flip a coin, it's 50-50, correct? 50 head, 50 tails. Once you flip 100 times, very likely, out of the 100 times, you have 50 head, 50 tails. So it always happened that way. So quite interesting. Okay, whereas for trading, I don't know what science you can use. Unless you say that human will always behave in a certain way once they see, which is also not true.
I see. Thank you.
Yeah. Okay, welcome. Okay, any other question? Thanks, Charles. Mind blown away. Okay, thank you so much. So what we want to do here is we want to be the casino of the investment world. Okay, don't be the gambler, be the casino. And of course, like every casino, every house, we will eventually be the winner. Okay, so with that, okay, let come to something else. So of course, the whole financial gym is for you to have this system in place. Okay, every month, pick up a stock, pick up a fund, and do it on a regular basis. Okay, so of course, we have some other questions to help us. Like for example, how much should we actually make? And which will actually lead to the other part. What kind of instrument should we be looking at? A lot of people always have this question. Should I invest in bonds? Should I invest in stocks? How many percent in bonds? How many percent in fixed income? So today you will actually get all the answer. And it all lies on the goal setting. Okay, so let's go to your Excel spreadsheet. So please open up your spreadsheet if you have not done so. Okay, let's do it together. I'm actually going to go through slowly. Let's do it together. Okay, so number one, of course, you have to set your investment objective. And a very common objective is for investor is actually this thing called financial freedom. Okay, so of course, if let's say you have other objective, like for example, you want to save $1 million to save the world or whatever, sure, can go ahead. But generally speaking, Okay, our investment objective is actually financial freedom. So I actually use that as a basis. Of course, after that, feel free to adapt the whole spreadsheet to something else. So let's have that base that all of us want to have achieve financial freedom. So what is the concept of financial freedom? So basically, passive income is able to cover your monthly expenses. In that sense, you don't have to work, and yet you can live happily ever after. That's what we call financial freedom. Your passive income can actually cover our expenses. So for us to achieve financial freedom, first we have to understand what is our expenses. So I have this spreadsheet here, which probably lay down what are some of the common expenses. Okay, so this is on a monthly basis. Your food, transport, utilities. You can actually do this spreadsheet for one person, or of course, if you are married, can do for 2 person. I just want to go through very quickly how I actually do it. So let's say, for example, food. I spend about $20 per day on food. So I do for 2 person. So me and my wife, $40 times 30. So that will be 1,200. Okay, something like that. Okay. Transport, I envisage I spend about $5. So my wife, $10. So times 30 will be about 300. So $300. Okay, utilities, now we are actually spending about probably about 500. Okay, utilities talking about your, of course, electricity, gas, then water, then not only that, like for example, you're talking about your conservancy fee, so on and so forth. Okay, so internet fee maybe about 100, phone about 100. Okay, give ang pao, also let's say maybe about 100. Entertainment, okay, maybe this movie magazine, maybe about 50. Oh, conservancy is here, sorry, conservancy is here. So conservancy is mine is actually now it's about slightly high. Okay, so maybe it's about 200. So down here I should reduce to 300. So this one is just electricity, gas, and water. Personal grooming, cut hair, okay, maybe 100. Now my wife need to cut a bit more hair. Then groceries, this one, your shampoo, your pimples cream, so on and so forth. So maybe another 200. Okay, medical. So this is the part whereby probably we will not need it now, but eventually we need. So maybe this one you have to put a little bit higher. So probably I actually put about 400. Okay, and maybe others another $100. Okay, so y'all can do for yourself, and or either that can do for 2 person. Okay, please do now. And let's go through it together. Okay, so I know that if let's say we do sometimes you forgot. So this is quite important. Hopefully you do now. Then we can commit to the numbers. Commit to our investment goal. Okay, so this is my case.
Sorry, Amy, can you explain conservancy again, please?
Okay, this one probably you're not paying. So let's say, for example, every month, if you're on HDB, you have to pay the town council fees.
Is it like those maintenance of the block kind of?
Correct.
Oh,
Yeah.
okay.
Then if you're staying in condo, you have to pay the what you call that, the maintenance fees. Yeah.
Okay.
Yeah. Okay. So this is roughly mine.
I mean, how about those insurance that you are paying monthly?
Okay.
Is that considered an expense?
Okay. So here's the thing. Okay. End of the day, we only look at expenses that were continue throughout our life. Okay. So by right, all these insurance after a while it will stop. Okay. Okay. After a while, you actually will stop. So like for example, if you actually talk about like life insurance, all this, actually when I retire, it can actually stop. I don't have to actually pay for it anymore. Okay, so of course, if you think that if you pay in full, then if the things that you pay in full, then probably you want to put it down, like you can put under medical. Okay, so like for example, this one actually do include like for example hospitalization, that one probably have to pay throughout. Yeah, that's why I actually put it in here. Okay, so this is what we call basic expenses. That means as long as we can wake up, we have to pay one. So you realize down here I don't have housing. Okay, so that means I have to assume that my housing have to be paid off first, then I can talk about my financial freedom lah. Okay, at the same time down here also do have my children expenses. So by right, after certain time, okay, I don't have to pay for my children expenses anymore. Okay, in other words, this one is just talking about pure expenses, pure expenses. Okay, so housing, children one, okay, the expenses that will not continue throughout lifetime, or either that, like for example, basically, the expenses that will not continue throughout lifetime are that one we don't include. So this one is just talking about your own expenses. Okay, so of course you want to add also can, but it can get very complicated. Okay, it can get very complicated. So end of the day, we have to balance between practicality and accuracy. So I think just consider the expense very good now. Okay, next, we also cannot just live on basic expense. Okay, we must have some traveling, we have some, maybe do donation, fine dining. Okay, but of course, this one we don't do it on a monthly basis. We don't travel monthly. Probably yeah, so fine dining we also don't do monthly. Yeah, so these are probably like per year basis. Okay, you may actually put a number, like for example, maybe traveling once a year we actually spend about $10,000. Okay, donation maybe 500 per year, maybe fine dining about, I don't know, 800. Let's see. Okay, so I will spend on average about $1,000 per month on my what do you call luxury expenses. Okay, don't have to consider inflation yet. Okay, later the Excel spreadsheet will take care of itself. So down here is basically current cost today, based on today. Okay, based on today. Okay, so if you have done this part and you see this number, okay, and you agree with this number, don't mind just help me type a 1 onto the chat, please. So basically, like in my case, I believe for me to sustain my current lifestyle, I need to spend about $4,000 per month. Okay, $4,000 per month. No, don't include your children's expense. Just either yourself or you have your spouse. Okay, so basically those expenses that you don't expect to continue, okay, forever, okay, you should not include. Okay, so we don't want to complicate the matters too much. Of course, after that you want to make a complicated version, sure. Okay, but then we just want to follow the definition of financial freedom very closely. What financial freedom means is that the passive income cover our expenses. Okay, investment, the rest, okay, don't have to be involved. Also, maybe we wait a while. Okay, the car expenses will be under transport. So of course, if you think that, when you actually retire, you actually want to have a car, yes, then you actually put under transport. Okay. Okay, now I assume that all of you have this number. Okay, now next question. Do me a favor. If let's say, for example, you are actually still working, okay, you are actually still getting a monthly income, okay, you want to know, you wouldn't want to achieve financial freedom today, not today, okay, put a 1. If let's say, for example, you are retired already, okay, and you have no source of monthly income now, okay, which means to say you want to know what you need to do become financial freedom, please help me put a 0. Okay, or long story short, if you are still working, if you're actually still working, okay, please help me put a 1. Okay, if let's say you are retired, please help me put a 0.
Emin,
Yes.
can I imagine I'm retired?
Okay, then you put a 0. Okay.
Okay.
Okay, thank you so much. Okay, so for those who actually put 0, 1, bear me for a while. You hold on for a while. Okay, for those who are still working, okay, down here, this is where you need to decide. You want to achieve, when you actually want to achieve your financial freedom. Okay, minimum is 10 years later. If not, the spreadsheet will give you very funny numbers. Okay, when you actually want to achieve financial freedom, is it 10 years, is it 20 years? So let's say, for example, I'm actually 45 this year. Okay, I want to achieve financial freedom, let's say, or retire 20 years later. 20 years later. Okay, then I just put a 20 there. Okay, you may want to do the same. Okay, inflation rates, I would suggest put about 3%. Okay, so this is about statistical. Basically, based on past 10 years, the average inflation is actually about 3%. I know that for the recent few years, it's only about 1%. That one is only talking about core inflation, which is like your very basic goods, your rice, your food, so on and so forth. But if you actually talk about like things like luxury items, even medical, okay, inflation has actually went up quite a bit. Of course, if you are a bit pessimistic, yes, you can put 4%. Okay, I think 3% is about there. Okay, so yes, you can try with the number 4%. Let's see how. Okay, end of the day, what this exercise does is this: it come up with a number you must believe in. You don't just do this exercise kind of number. It's like, I don't believe this number, I don't care. No. Okay, what we really want here is this: after this exercise, you come up with a number that you believe in it, you feel committed to it, you want to achieve it. So that is what we hope to achieve here. Okay. Now, okay, monthly from pension scheme. So this one is optional. So for those who actually want to a bit more precise, okay, you may actually want to put down, like, for example, CPF. Okay, CPF is actually going to give you some money when we retire. Okay, if you actually want to be more precise, you can put down probably per person is about 1,500 to 2,000. Okay, for me, I will tend to leave it blank. Okay, so to me, CPF is additional pool of funds that I would have. So I will leave it blank. Okay, the next, returns achievable after financial freedom. Okay, now this one, you have to ask yourself, if let's say, for example, when we retire or achieve financial freedom, would you still be an active investor? Active investor is someone who actually spend maybe one day at least 30 minutes to look at the stock market, to look at his investment. Okay, if you think you are going to be an active investor, you actually put 6% here. If you think that no, after you retire, you will just don't care about investment, you will just basically don't really care, don't care about investment, then you actually put 4%. Okay, so for me, I believe I'll be an active investor. I will actually put 6%.
Sorry, you mean the 6% is derived like the minimum you want to get back from your investment, right?
Correct.
Okay,
And
thank you.
okay, it's also more like, let's say, for example, you do active investment, very likely you can hit at least 6%. But if you are like a bochup investor, okay, probably you can only hit about 4%. Okay. And this is the amount I need to achieve my financial freedom in 20 years' time. Okay.
Sorry, you mean this
Yes.
amount is in today dollars or 20 years later dollars?
This in 20 years later.
Oh, okay.
In 20 years later. So if let's say, for example, okay, I want to achieve financial freedom in 10 years, okay, you realize that, wow, immediately is lesser. Okay, but then you have to be reasonable to yourself. Do you think that in 10 years' time, you can actually accumulate $1 million? Okay, I'm quite sure a lot of people want to put here as low as possible. So what is probably fair is use 60 minus your current age. 60 years minus your current age. That is probably fair, minimum. Okay, so I actually put 20, 1.4. Okay, now, can you please do me a favor? Okay, please help me type into the chat what is your number, and let me know, is it for 1 or 2%? Okay, so don't mind, just help me type in the chat. Like for example, in my case, 1.4 million for 2%. Can I just trouble you to type on the chat what is this number for you and for how many person? Okay, of course, if there's any question, please ask. So I think this is an important exercise. $1.3, $1.4 for 2, 1.3 for 1, 1.5 for 1, 1.6. Okay, for those who actually put like 1.3, 1.5, 1.6 for one person, am I right to say that you are either 30 years old or below? Still very young one.
Yeah, you mean you guess my age?
Okay, then it makes sense. Then it makes sense. Yes, then it makes sense.
Is it a bad thing? Why the number like so big? Like so scary.
No, but you have more time to accumulate also at the same time.
Okay.
Like for example, if you actually put lower, like 10 years, okay, like my case I said 10 years, okay, this number is smaller, but I have lesser time to accumulate this 1 million.
It's like more steep lah, right? More
Correct. Correct. So you have to put a reasonable number, which is minimum is 60 minus your current age. So of course,
so
if
like
I put
those very big number, you guess that we have a longer runway lah, is it?
correct. So obviously, if let's say this number is larger, right? Okay, this will be higher, but I have a longer runway to actually go and accumulate.
It's higher because there are more years with the inflation also, right?
Correct, that's right.
Understand. Okay.
Okay, Minghui, just bear with me for a while. Okay, good. I think all the numbers are within range. Okay, all the numbers are within range. Okay, very good. Okay, now, so for those that who are retired now, okay, so for those who are actually retired already, so here is the thing. This is what you do here. Down here, you actually don't put anything or you put 0. Okay, this is for those who are retired or who are not gaining income right now. Okay, you put 0. So basically, like for example, let's say I'm retired today. I need $4,000. I need a passive income of $4,000 every month. Okay, and what you do here is this: you have to play around with this number. Okay, to see whether you have this amount or not. So let's say, for example, I have $1 million. Currently, I have $1 million. I need to achieve 4,000 every month. So in fact, my $1 million only need to grow at give me 5% return per annum. Okay, I am financially free. That is what it means. Okay, I repeat. So for those who are retired, okay, you are not, you need to be financially free today. You want to make sure that you have passive income that cover expense today. This is what you do. Down here, put 0. Okay. Then you ask yourself how much you have. Okay. And you basically play around with this box. Okay. This box. You play around with this box. Okay. So that you will hit the number you have. So let's say, for example, I only have $800,000. Okay. That means my money need to generate 6% return every year. Okay. If let's say, for example, I only have $700,000, I need to have 7%. Okay. If let's say down here have to be more than 10% one. Okay, so let's say if I only have 400,000, sorry, I cannot retire, I have to come out and work. So maximum down here should only be about 8 to 9%. Okay. Questions? Anybody, any questions?
Jimmy, I got a job for me or not? Got to come out and work.
You no need to work already. Yours is 2%, right? If I'm not wrong. Okay. Okay. Thank you. And anybody else has any other questions?
You mean,
Okay,
sorry, if every
please.
year, right, I want to take, like sort of top up my own CPF, right? Do I need to put this inside the calculator? Every year I set aside some money that I want to throw inside my CPF. Do I include it here?
No. Okay, so basically for those working one, what we actually do here is now helping you to set a target. That's all. Okay. So now in my case, I actually putting CPF aside. I actually need to have 1.4 million. Then I can talk about retirement. I can talk about financial freedom. Okay, so my goal is actually very clear. Every day I wake up, I ask myself how far away from this 1.4 million. That's what I actually do now. Okay, and I actually put CPF aside. That means CPF I contribute normally, then after that I don't care.
Okay, got it.
Yeah.
You're also assuming that the house is fully paid, right?
At my point of retirement, yes. Okay.
So it means, so basically by 65 means 20 years later, you would have achieved 1.4 million. Is this what the Excel is trying to show?
No, what it's trying to show here is this: I should have 1.4 million when I reach 65. If not, I have to continue working.
Okay.
Or put it in other words, if let's say once I hit 1.4 million, okay, I can basically don't need to work already.
Provided your expense stays the same, right? If not, like,
no,
it will
this
increase,
expense already included inflation.
Okay.
Okay, this is actually based on today's term. So today I'm actually spending about $4,000 every month, me and my wife, and it's actually increasing at 3%. So in fact, 20 years later, the same basket of goods here, it will actually cost us about 7,000. Okay, it actually costs about 7,000. So for me to actually generate $7,000 per month, that's where I need my 1.4 million.
So basically, you mean that by the time you retire, you need 1.4 million to have 6% return to generate the 7,000 plus to be able to have this passive income to support you from that point on, correct?
Correct, yes.
Thank you.
That's what it means, yes. Okay, it's a target to gauge. Correct, Ming Hui, you can put it that way. Yes, this is the target. Okay, and target for my expense. So y'all can see differently. Okay, that's why I don't put the house. Okay, then of course, let's say for example, assuming 10 years later, I have 1.4 million cash already for my investment. but my house is not fully paid yet. Then I cannot totally retire lah. I just have to make sure I fully pay my house. Then I have 1.4. Then I am fully financially free. Okay, so this one is just for your expenses. Okay, so I like the way Ming Hui put it. So this is a very clear target, clear objective. Don't belittle this number. So this number has actually guided me very well. I am now not controlled by greed. So when people tell me, oh, you try to do this, you can get money faster. No, okay, I'm not interested. Okay, I am very clear what I'm actually there working for, 1.4. And in fact now, I can pace myself better lah. Okay, I roughly know that, okay, if I continue this way, I can hit this objective probably in 10 years time. So I can better pace myself and try to focus on other important things in life. Okay, rather than always keep thinking that not enough money, must go and fight for money. But I roughly know that, with this number, I can quite save lah. Okay, any other questions? Okay, if not, we want to do a very important exercise. Okay, do you agree? Okay, so like I said, this one is a very important commitment. The thing I want to achieve here is actually commitment. I wouldn't want to like, oh, just do this exercise, this number, then that forget about it. Then that defeat the whole purpose. That defeat the whole purpose. Okay. So the next question here is this: do you actually agree with this number? Okay. Yes or no? If no, why? Maybe don't mind, can you just share? If yes, if you think that that should be your target, just help me put a yes into the chat. Okay, if not, then maybe it will be good if you put no, and it will be good if you actually help me put a reason why. Okay, Adam, I answer your question later. Thank you so much. Okay, so the key thing here is to be committed to this number. So hopefully, you will take some time. And this is the reason why I go at length to go and do all this. Okay. Hopefully, eventually, you'll be committed to this number. And I think it's actually very powerful. Okay, we come that one by one. Says Rani, thank you so much. Yours is 3 million. Okay, Surani, 3 million. Can I just confirm, Surani, what is your number here? 3 million a bit high. Total money, what's your total money here, Surani? Surani, is it okay? Can you share with us what's your total monthly current cost? 3 million is a bit high. If it's 4887, oh yeah, correct. You're actually very young. Correct. Yeah. That means 30 years. Then you mean 3 million. You put 4% here. Okay. Okay, about that. Okay. But you got long runway, it's okay. Okay, so I see a few questions. So in fact, I have already factored in. I have already factored in inflation. So like for example, in my case, today I need 4,000, but I'm actually planning for passive income of 7,000. So I have already factored in the inflation already. So to Jonathan comment and to Jonathan's comment, I don't really agree with you because I have factored in the inflation here. Okay, unless you are talking about when you get older, you need a different lifestyle. Okay, now you only eat hawker food. Then when you get older, you must have Michelin star restaurant every day. Okay, unless that happens. If not, we are talking about your current lifestyle and the inflation factor has already been factored in. Okay, so Jonathan, hopefully I address your point. If not, feel free to add. Okay, answer to question Adam. Okay, so of course, if let's say it's 15 years, the inflation is lower, Can you see? Okay, so let's say, for example, I put 15 years. Okay, the inflation is lower. So of course, down here will be lesser. Okay, but the thing here is this, you would have lesser runway to achieve this 1.2 million. Can you do it or not? Okay, so let's say if I want, I put 5 years. 5 years, for me to retire 5 years, I need 948. That means 5 years later, I need to achieve 948. Can I do it or not? Okay, so be realistic. Like I said, the minimum you should put is 60 minus your current age. So this number should be minimum, should be 60 minus your current age. Okay, so hopefully after today's session, if you ask me what is the main takeaway, it's really be committed to this number. I'll be committed to this number, and hopefully you've done that. This is my number, hopefully it's yours. So now I have a very clear investment objective, 1.4 million investment asset. Okay, then after that, fully paid property. So with this objective, I plan my investment, okay, to achieve this objective. That's how the creating wealth accumulation system work. It all start with a very clear target board. Hopefully, you all will actually do the same. If you all think that this number doesn't make sense, please try to replay this exercise until you feel committed to this number that, okay, that is something I want to achieve. Okay, if everything is okay, we come to the next tab, custom ISP. Okay, you can see that, okay, this number will automatically be port over. Okay, how long will also be port over. So this question here says, how much do you have for investment, right? So the question is how much money you have in your bank account right now that you can actually use for investment. So let's say, for example, I have 200,000. Okay, so this money will actually include things like, for example, the current insurance you already have. Okay, if let's say, for example, you have investment property, a second property, so this number will actually include the equity portion of your property. Okay, so basically we want to know how much money, let's say, for example, I want to know how much money you can take out for investment today. For investment, so this is what you should key in. Okay, money you can use for investment. So money, the emergency fund, not here. The money used for your daily living, not here. Really savings money you can actually use for investment. Okay. Then this one is per month, how much you can actually set aside for investment. So let's say, for example, my case about $2,000. Okay. And by keying these two numbers, basically, for the next 20 years, I need this 200K and this 2,000 to grow by at least 5.53%. Okay, to hit my 1.4 million in 20 years time. So once again, this is all the money you can use for investment right now. How much you can actually save from investment, save for investment. So money can put aside for investment. And what we actually do here is actually calculate this number. Okay, how much percent your money need to grow so that 20 years later can hit your target amount. So can I just trouble you, just type onto the chat, what is this number for you?
Sorry, you mean if
Yes.
like we are like, for example, you just started working, then you don't actually have capital for investment, but you're willing to set aside money every month. Does it mean that for the how much you have for investment now, you just times 12?
No, now you put 0 lor.
Oh, okay.
0, yeah. Okay, thank you, Minghui. Thank you, Adam. Okay, Jonathan, thank you so much. Thank you so much, Edison. Thank you. Oh, Charles, 20% cannot be. 12% is on the high side also. Oh, Charles, 20%, you have to relook. Yours is 1.4, you're about 20 years. Okay. I'm quite sure down here you have more. Cannot be 20% one. Okay, thank you so much. Okay, please make sure. Okay, just now you said this is 1.4. So if I'm not wrong, down here yours is also 20. Okay, so it depends on these two factors lah. So I don't think it's so even if let's say for example down here yours is 100. And if let's say you can save 1,000, which I think can do more, it's only 9.94, so cannot be 20%. Okay, good. Thank you so much. So very good. So basically, this is again another very important number. So in fact, this is the number I also hold very true. So all my investment, okay, or at least on average basis, I want the my return to be about 5%. So in fact, as much as possible, okay, if you talk about investment, I want this number to be more, my investment to be more than 5%. Okay, so every 13% serious 13, but anyway you are still young, okay, so maybe
No, because I based on what I currently have, like minus off the expenses, so I can't really put a lot every month. So that's why I put lower.
Okay, down here is lower, right?
Yeah, down there is lower.
Okay, anyway you are still young. Yes, 13% for it is still okay. That means, yeah, you should actually consider a slightly higher risk instrument maybe when you are young.
I'm very scared like the US market one, I already want to die already.
Yeah, but if let's say that is objective, that is something I do. So, so this one is hopefully help you make life decision. If let's say you wouldn't want to take the high risk, then you may have to consider lowering your expense. Okay, you can think of lowering your expense. But I think at your age, even 13% actually quite okay.
Thank you.
Okay, great. So the rest is quite okay. As long as it's actually between less than 10%, I think it's actually quite good. Okay, less than 10% is actually good. So again, hopefully this gives you a gauge. So in fact, this is the reason why personally I'm not a fan of bonds. I don't like bonds. Okay, why? Because it actually gave me less than 5%. Okay, I'm actually more into equities. I'm more into REITs. When I buy REITs, generally speaking, I only look for REITs dividend yield more than 5%. Okay, for very obvious reasons, as you can see here. I want most of my investment to be actually more than 5%. Okay, so hope you can see the power of all these numbers. Okay, very good. So in fact, all your numbers are actually quite fair. You probably have done quite well. Okay, Ivan, I hope you are young. Sorry, I didn't get to see you. Yes, if not, generally speaking, if let's say, for example, if you're above 40, okay, that number should try to be less than 10%. Okay, then you may have to consider making changes, some of the changes here. Okay, if not, I think the rest is actually all below 10% is actually quite good. Okay, so this is one use for this number, really helping me to know every time when I'm being given a product, okay, I know already I need 5%. So bonds, don't bother. I really don't bother about bonds. Okay, I have some investment that's less than 5%, but for other reasons, like for example, CPF is less than 5%, but I still use it because no choice, so I have to put money in CPF. Okay, My endowment is less than 5%. Why? Because I want some certainty, and it actually have an insurance element. If not, all the rest of my investment all above 5%. Okay. So those who are 6, 7, okay, those on the 9 one, then get ready to do more into equities already. Okay, no choice, do more into equities, have to focus a lot more into equities. Okay, now once this is okay, okay, the next exercise you want to do here is this. So basically you have to play around with the numbers here. Okay, maybe I'll explain a bit of this table. So these are the different instruments that we are going to cover in the wealth accumulation system class. This is the average return per annum. Also, this is based on historical. Average return per annum. So what you actually need to do here is this. You actually put in the percentage holding so that down here become 100%. And down here, expected return will be higher than your required return. Okay, or when this box become green color, so like for example, this is what I do. So maybe I just try everything 10% first. Okay, like I said, I'm not a fan of bond. I do unit trust bond though. Okay, more for diversification. Okay, I think I can go more into okay, I'm a stocks fans. I put 20%. Okay, ETF, REITs. Okay, then maybe I can just put another 20% into endowment. Okay, 6.45, higher than my required return. And this will be my ideal portfolio allocation. So a lot of people ask, how should you actually allocate a portfolio? This is the most ideal way. It's not a function of risk. A lot of people say that, oh, it depends on your risk appetite. If you are someone who are risk adverse, go for bonds. If you're someone who can take more risk, go for stocks. No, it really depends on your investment objective. Okay, that first. Okay, that first. Okay, so for me, okay, the minimum is have to make sure I keep 5.5. Then of course, if let's say, for example, I want to have a risk consideration, then I should just try to be a little bit above 5.5% will do. So basically, if I want to be a bit more risk adverse, I should do more on endowment. Then maybe less on stocks. Yeah, something like this. This will probably be ideal if I actually want to have a risk consideration. But of course, personally, I am happy with stocks. So I think this allocation is actually good for me. Okay, anybody has any questions on this part? Okay, and this is how you do a proper asset allocation.
You mean
Yes.
based on my initial because I don't still really understand the unit trust thing, so I put for endowment, REITs, ETF, and stock. But it's not enough to cover the interest that was calculated in the calculator, right? So I have to keep on, like, for example, if I believe in ETF, I up my ETF percentage, right? Then it will become very skewed. Like, for example, 80%, that kind, 80%, is it okay or?
Yeah, for you, no choice. So let's say, yeah, that happens. So
it's okay for it to be skewed a little bit, right? I mean,
yeah, no choice. So of course, the other way for you to do is you can save more here.
Okay.
You can work longer.
Okay.
Or you can reduce your expenses. Yeah.
I see.
So you can play around with those. But if let's say all this is maintained, yeah, I think at your age is actually quite okay. And in fact, yes, when I was your age, yeah, a lot more into stocks. So.
Okay, understand.
Yeah. Okay, like for example, Ivan and Erin, yeah, assuming you are young. Okay, I know Erin is young. Ivan, sorry, I didn't get to meet you personally. Yes, you're basically talking about just put your money here, the ETF and stocks. Okay, don't bother to think about bonds and things like that. If let's say, the rest of the things you don't want to change. Okay, is
I
it
changed my
risky?
expenses already.
Is it
And
risky?
now,
Yeah. Is it
now
risky?
9%.
Yeah. Is it risky? Yes, it's risky. Okay, I don't deny the fact. Let's say you focus it's risky. So end of the day, life is a choice. If you think this is too much risky, you want to reduce, then you have to reduce your expenses. Okay. If you really want to maintain your life, you're happy to take the risk, why not? That's life.
I decided I'm going to set aside a bit more money for investment.
Okay,
Then the
very good.
percentage drop.
Okay, thank you. That means this exercise has been very helpful. Thank you so much. Okay, I got some
I don't
questions
dare to
coming.
anyhow go Taobao liao.
Oh, yeah, yes. I have met my objective. Very happy.
I'm very scared now.
Good. Okay, Adam has a question. Keep some cash, like 20% for Black Swan event. So that means you have one category called cash. Okay, now, I have already kept here. Okay, so basically, all this money is excluding my emergency fund. Okay, this 200K is the money I have purely for investment one. So that means you have excluded my emergency fund. It have excluded my living expenses. Okay, so it's not every single cent I have in the bank right now. No. Okay, same for this amount. So this amount is my salary, right? Minus off, all the expenses, all the emergency fund, blah blah blah. Okay, so in that sense, we don't need to, the cash component is not here. So we are talking purely about investment. Okay, Ivan, thank you so much. Then yes, you may actually want to have a lifestyle whereby down here the best is can be less than 10%. If not, yeah, if you want to maintain a lifestyle, if you want to hit financial freedom, then sorry, no choice. Then you'll ask yourself, are you willing to take the risk and focus more on this part now, ETF and stocks?
You mean that if my ETF is like more like, for example, 50%, but not every ETF can give like a 7% interest, right?
Correct.
So does it mean you just choose, you might have more than one ETF also, right? Does it mean you just choose until like the total return is 7%?
Yes.
Okay.
Okay, so of course after Jimmy's lesson, maybe Jimmy, you want to comment? After Jimmy's lesson, yeah, you won't be looking at ETF that give you less than 7%. So after you hear from Jimmy, now probably you are talking about 18%, right, Jimmy?
I'm quite surprised that you asked these questions. No, if ETF you look at 7%, then it's not worth it, lah. By the way, ETF is that there's, first of all, we have to get through the idea. Of course, we will talk in details. Is that you need to do your so-called your investment review once every 3 months, once every 6 months, and we look at ETF that will grow anything between 12 to 18% on a conservative side. But if you're looking at growth, you're expecting to grow something more than 20%. So there are systems to do it, but I will cover those in the ETF lessons. So I wouldn't be looking at ETF. It's just 7%. I mean, to be honest, and Emin is correct on that part. Right? Thanks.
Okay, thank you so much, Jimmy. So of course, Ming Hui, I believe that answered your question. So end of the day, you join this class. Yes, we won't be just touching on those ETF that is least sexy lah. Okay, so of course, Xiao Yu also have a very good point. End of the day, why I put 7% here is because end of the day we are talking about portfolio of ETFs lah. A portfolio. So again, don't forget what I mentioned up front. Okay, we want to be the casino in the investment world. So we have to just buy different instrument at different time. So net overall is about 7. I put 7 here. Is actually very what they call it, very conservative. Jimmy will share with you some of the ETF, what kind of return they're actually getting, and he has real result to show.
I have a question to ask.
Yes, please.
You know, when we look at what the sovereign funds report, right? They're talking about 3%, you know, growth rate, maybe 4%, and it's supposed to be very good already. So why is it, you know, if they don't, you know, why is it that we don't expect them to hit 7 and 10%?
Okay. So you're talking about, like, for example, Temasek and GIC, is it?
Yeah, I mean, yeah, Temasek, GIC, yeah.
Okay, so basically, there if you ask me, of course, I'm not them. my guess, there are two reasons. So when they invest, they also need to invest on national interest. One episode I can remember is this, like, for example, they are very heavily invested in Olam. And that is because Olam is actually into commodities that Singapore needs. So they have such consideration. Okay, and for GIC, they have to be their mandate is they have to be what they call it, mostly in bonds. Okay, that is their investment mandate. Okay, so they cannot take too much risk. Yeah.
Maybe I can just add on to what Emin has said. Emin is correct. So to answer Arvin, your question is this. When you talk about sovereign funds, they are really huge. They are so big that they can buy almost anything, everything. But then the thing is that much of those are into what we call the fixed asset, you know, like property, land, or, you know, things like that. So as a result of that, right, if even if they would take a very high risk, for example, like the one of those PE fund that they invested in and they open up to retailer, you know, one of those PE funds, even those funds that they are invested in the 20 to 30% kind of growth per year, but you average out with the whole big lump sum of money that they are actually invested, right? The return of 2% is really, really a huge amount of absolute monies, really. So that's why you are only looking at 3%. So imagine that, for example, if Bill Gates' wealth can increase like 20% per year, wow, I think he's amazing really. He's really like superstar of a superstar of a superstar really. But I think for Bill Gates to increase, let's say, like only 1.5 to 2% per year of his total net worth in terms of investment is really, to him, is really big, because you must understand that his fund size is huge. That's my personal take on that.
Yeah.
Thanks.
Yeah. So thank you so much. So end of the day, they also have to balance with risk. Like, for example, when I was with CapitaLand, okay, so actually CapitaLand, a lot of people don't know, is they actually behave more like a fund manager rather than a developer. So for them, their objective is actually not to maximize return anymore already. Is actually get a risk-adjusted return. Okay, we all know the higher return you aim to achieve, the higher risk it is. So once you actually get that big, you don't want to actually take that kind of risk anymore, you see. So for them, they actually don't aim very high one. Yep. So that's what I understand. Of course, it probably could also be that they are not performing well. So anyway, there's another conversation for another time. Okay. A question from Ivan. Can I skip endowment? Because it will lock my money for 3 to 5 years. Okay, so again, Ivan, is a function of risk. It's a question of risk. So the most ideal is we should, try to have at least stocks in all the spectrum. Okay. Why I don't do bonds? Because I see my endowment as a fixed income. Okay. For a start, now, let's say, for example, zero investor, I think you should spread out into all different instruments first. Okay. After you spread out, then you will realize each instrument has their pros and cons. And from the pros and cons, then you adjust accordingly. So I wouldn't suggest that you actually skip endowment totally. Okay, or either that, if let's say scale endowment, maybe you want to try some bonds. Okay, end of the day, we need to have a balance. Okay, I give you my personal example. Like for example, last year when I hit by COVID, last year we all hit by COVID. Okay, basically all these are not doing well. I'm quite sure you all know, but endowment actually is there. You know, it doesn't fluctuate. It actually gave me a lot of comfort. Okay, so I wouldn't suggest. You may have lower percentage first, then you play around the rest, then you see, understand the pros and cons, then you decide. Okay, hope I answer your question, Ivan. Okay, good. I know at least make one person spend less money already, very happy. Anybody else has any other questions? So again, I hope you all treat this exercise seriously. Don't just do already. Oh yeah, that's it. The key, I know I'm repeating myself because it's important. The key is being committed. Like in my case, I'm committed to my 1.4 million. Every day I ask myself, how far away from this 1.4 million? I'm actually committed to this 5%. Okay. Every time I see an investment, okay, I want to ask, okay, can it be more than 5%? Okay, so end of the day, all this actually give me a guide. Okay, so you can see here, it actually helped me to spread out. So of course, ideally speaking, my $2,000 every month, or every month I put $400 in endowment, $200 in bonds, $200 in unit trust, $400 in REITs, so on and so forth. Okay, so ideally this way, but of course we know that on actual fact, it may not be able to work that way. So like for example, for stocks, it may make sense for you to buy, every time you buy about 1,000 minimum. Okay, ETF maybe makes sense for you to buy 1,000 minimum. Okay, then in that case, what I do is maybe this month I buy to stocks. Okay, then next month I buy to ETF. Okay, certain things like for example, unit trust, I do my regular saving plan. Okay, so that I can actually stick to this. Okay, whereas for this one, okay, maybe I 1 month buy REITs, 1 month buy ETF, 1 month buy stocks. Then I repeat the process rather than split. Okay, but this one gives you a guide. So this is what we actually has been doing in our investment gathering. So in the investment gathering, I got $5,000 every month that I will allocate based on this. Maybe I can give you a quick snapshot.
You mean?
Yes.
Can I just check? If I don't put the money in the endowment, I put it into my CPF RA. Is it the same?
Yeah, I would think so. Now you can actually withdraw your RA anytime, right?
No, that's OA.
Your RA, can you can withdraw the money, but once you put in, they actually give you higher.
You can't withdraw RA. You can withdraw from your OA if there's any, or SA if any, if you shield your CPF. RA you can't withdraw until 65. Then you have CPF Life.
Okay, but once you put inside RA, okay. Oh, okay, yeah. Correct. But once you put RA, once you hit 65, you get more out, more money out lah.
Yeah,
So
that's
I was
correct.
thinking instead of endowment, I just put into my RA. I got a slightly more percentage than
Okay.
endowment.
Okay,
Yeah.
so don't mind me asking. Okay, a bit sensitive. So if let's say, for example, I don't know how old you are. Sorry. So let's say I am 50 something. I'm not 65 yet. Okay. Once I put money in, it's locked in already lah. Then are you so sure that you don't need the money? Okay, but if let's say I'm 65 already, I put money in, I can get more out. Yeah, then I think it's fine.
Okay, I'm close to it.
Yeah, then I think it
Okay.
makes sense. I think it makes sense.
Okay, maybe I can answer that question. So I'm closer to Vivian's requirements. Okay, so between 55 and 65, RA will be already open up, already given to you. So what you have is that you will have your 4 account, OA, SA, RA, and MA. RA, whatever amount is going to be exactly what you have said, Vivian, is going to be you can treat as a annuity. All right, you can basically put money into your RA, so that when come to 65, right, then your CPF Life will pay out more according to whatever amount that been accumulated at the age of time. Now, of course, between 55 to 65, if you have excess money in your OA or SA, the first priority is that every money that you withdraw, it has to become from SA first. Then after the SA being withdrawn complete, then it goes to OA. So that's how it works for the time being. Yeah.
Okay.
Because I don't quite like endowment or bonds, so I was thinking of putting money into RA.
So I can add to that. I swear by the RA. I think it's a very good instrument. As much as I put as much as possible to top up the RA, because I think it's guaranteed, and the surety of getting a certain amount every month when you stop earning is amazing. I think that's for me that's what I work towards.
Oh, thank you, Arvin.
Okay, thank you so much. A similar question from Ming Hui. So currently 7,000 annual contribution SA will count towards the endowment as I don't take up anything yet. I have 25 years to 50 years. Okay, Ming Hui answer is yes. But here's the thing, okay, I realize now, okay, there's one issue for a lot of Singaporeans. In fact, a lot of Singaporeans get displaced at 55. Okay, but CPF Life, okay, at 55, you can actually withdraw from OA, like what Jimmy has mentioned earlier. But the CPF Life will only contribute money, give you the payout from 65 onwards. Okay, so now if let's say a Singaporean 55 got displaced, not working anymore, okay, so 55 to 65, he is actually not getting the CPF Life payout yet. So if let's say you put in money, like what you say just now, but at 55, assuming that after that you have at 55 you cannot take any money out, okay, then you'll be in some trouble. You have to wait until 65, then the CPF Life money will pay out. Okay, Ming Hui, I don't know whether you actually understand where I'm coming from. That is the thing I'm actually worried that a lot of people get trapped right now. Whereas for endowment, okay, you can actually choose when is the payout period. So if you can have endowment today whereby let's say I pay up to like 55, then 55 onwards, I actually get that payout already. Okay, but of course, if let's say if you contributed enough, if you contribute enough at 55, you can take out one lump sum from OA, then that's fine also. Okay, so in that case, about all these CPF, endowment, Jimmy next lesson will actually talk about a bit more. So that's the part. Okay, so recently I've been seeing a lot of people at 55, they are so worried they lost their job. CPF Life only pay out 65. So in fact now 55 to 65, that's the one that is actually quite worrying for a lot of people right now. Okay, good. Thanks for all the questions. So just to come back, so during the monthly meeting, that's where I will share, like for example, okay, this is the holding as I had just now. So every month we will invest. So every month I have $5,000 invest. So as you can see here, it doesn't mean that, oh, I always invest accordingly to this allocation. No, okay. Like certain times, like for example, I think this is the last month one. Stocks I'm okay. Endowment I am too little. Okay, ETF I have too much. Okay, then I will just adjust accordingly lah. So like maybe for example, maybe next month, I should buy more on REITs and buy more on endowment, for example. So this one basically just serves as a guide, not a hard Bible. So after maybe like 2 years, then I should have a steady state, which is about something like this. Okay, hope you all know what I'm trying to get now. So don't need to like first day or die must follow this allocation. No, it just serves as a guide. Roughly, it should be around this range. And if let's say I'm too much into stocks, okay, then I should focus a lot more on ETF, REITs, so on and so forth. Okay, so that's just give me as a guide. Hopefully that one is clear. Great, thank you so much for the discussion. Okay, if this is okay, I just move on to the last part, the milestone table. As you can see here, if you click on this milestone table, again, a lot of numbers are actually imputed here. So you can just put the current year 2021. Okay, so what I have done here to help you to set up your milestone table. Okay, your milestone table, I would strongly encourage you all do this exercise at least once per year. I'm doing it monthly. I'm actually doing monthly. Yeah. Okay, this is what I do here is every month I will actually just calculate all my money in different investments. Okay, how much money I have in my cash, what's the cash value of my endowment, what's the cash value of unit trust, okay, so on and so forth. So every month I will just tally down. Okay, in total, how much money I have, okay, in all my different various investments. And then I compare with the milestone. Okay, so of course, hopefully it can surpass the milestones. Okay, that means you're on track. So basically this one will actually help me to see whether I'm on track to hit my $1.4 million. Okay, which is also why now I'm quite happy because I don't think I actually need 20 years to hit my 1.4. I probably can hit my 1.4 million a lot earlier. And how I actually know is actually this milestone table. Okay, so what you actually do here is this. So this milestone table actually is cast in stone. You just have to really note down at least once per year what is the value, and after that compare to see whether you are aligned. Okay, to see you're actually in place. Okay, also this is what we call a very full detailed financial planning, starting from setting your investment goal, okay, to understanding the required return, to asset allocation, and after that to milestone table.
Sorry,
sorry.
Yeah, go ahead.
Ma, you want to go first?
I just want to ask how you get the milestone table or this.
Yeah, there is
on this figure.
Yeah, it's a financial calculation. So let's say, for example, I need 1.4 million 20 years later, right? Now I have 200,000. So I do the financial calculation to see how much my money will grow. Yes, Ivan, answer is yes. Okay, so this one is a target. This is my annual target. Okay, you can see it's a financial calculation here.
Sorry, Emin, I got a question. The allocation of the cash endowment bonds, all this is the endowment bonds, all this is based on your percentage allocation, right? Assuming if I have like golden hands like Jimmy, right, then my ETF is at more than 7%, right? But this calculator only shows that up to 7%, correct?
Okay, you're talking about this page or this page?
Talking about the milestone table. The milestone table, the ETF. Oh, there's no formula, is it?
No, this one is to key in the exact value.
Oh, I see. So
your real life
regardless
value.
of the percentage.
Correct. So,
oh.
like for example, I will just log into my FSM1 page. I'll go and see what's my value of my ETF right now.
Okay, I understand.
Yeah, just key in there. So if I'm like Jimmy like that, I'm very happy.
Yeah, Jimmy, I need your golden hands and your golden brain.
Yeah. Okay, but I heard Jimmy very selfish one. Don't tell everything.
Jimmy what? Jimmy has a very expensive lifestyle. Sorry, that's why I have to work very hard.
Okay, so anyway, yeah, so this one will let you know, okay, so this is like an annual target. Annual target. Again, this has been very powerful for me. So, when I don't hit my annual target, then I have to relook and see, hey, what is wrong? Then do I have to put more into stocks and so on and so forth? Okay. So I actually set this annual target, and as long as I can surpass this, I know that I am in line to hit my 1.4 million. Okay. So I actually do this monthly, just to let you know. Every month, I just go and check how much money I have in the cash, how much money I have. I do say month until now I become a bit money face.
You mean,
yes.
on the milestone table,
Yeah.
Is there a column missing for stocks?
Oh yeah, you are correct. So okay, you can just add in. Okay, you can just add in stocks. Okay, I believe the formula will still factor in. Yeah. Yes. Yeah. So yeah. So what you do is you just what I did just now, insert. Okay, maybe I'll just send this spreadsheet again to you all. Okay, thank you so much. I will just send this spreadsheet again to you all. Thanks. Thanks for pointing out. Okay, questions are coming. Good. Is the milestone table to reflect total amount including base value? Yes. So basically this is really the actual value. Then you just compare. Need to net off debt like housing loan for milestone table. Okay, so I'm actually only looking at investment here. So you can see, unless like for example your housing loan is an investment property. So let's say you have one item here called property, for example. Okay, so property is one of your investment. Okay, then down here you should actually put your property value minus off the debt. Okay, the housing loan for your own stay one is not. Okay, that one we actually don't consider as an investment, at least for this or from the perspective of this table. So Adam, hope I answer your question. Oh yeah, Edison, yes, if you want to buy early, you can buy Jimmy coffee. Okay, Erin, thank you so much. I've included. Okay. Okay, good. Okay, any other questions about this financial planning exercise? Hope it has been
Sorry,
useful. Yeah.
Building on the point just now, you mentioned the property one, right? Assuming next time if I have a property like rent out, that is also considered a form of income, right?
Yes, investment property, yes.
So I can add it into the column, right?
Yeah, only the equity portion, which is the value of the property minus off the loan.
Okay.
Yeah,
okay.
So that means we call it equity portion. That means what is really yours.
Okay, understand.
Yeah, yes, yeah. You may not do that. If let's say property is one of your investment.
Okay, thank you.
Okay.
Sorry, Amy, can I just ask, right? So for
Yes.
the so-called current savings available, right? In terms of this table, right? Is that the sort of a baseline? Because I would have assumed that per year, whatever is all the rows is basically your as-is position in terms of your entire asset portfolio, I guess. The question is in terms of the monthly investment, right? Because whatever monthly amount, we have a portion accordingly. But what about that? The initial amount for that. How much do you have for investment now? The amount, how do we allocate that part?
It's also here. If let's say, for example, after 1 year, I still don't invest, then I just put my 200K here.
I see. So that amount, actually, we can apply the similar so-called allocation factor, I guess, for that initial amount as well.
Oh, okay. How do we actually allocate this 200K, right?
Yes.
Okay. Yes. So eventually, it should slowly go into this holding, this percentage holding. Yeah, correct.
Right. So this percentage holding can be used for both the current your available funds for investment as well as your monthly investment.
Correct. Okay. But please don't do it one shot tomorrow.
Sure.
Okay, that I would have heart attack. Okay. So generally speaking, so it depends on the amount. So it should be about take 1 year to 2 years to, let's say, assuming let's say 200,000 is all in cash right now. Okay. I think it should take about 1 to 2 years to fully invest this amount. Please don't do it one shot tomorrow. So let's say I take 2 years is equal to this divide by 48, for example. Okay, so every month I would have about $6,000 to invest instead of 2,000. Okay, I will do that.
Just wondering why 2 years? Does it matter what's the amount you're starting off with?
Okay, it's good to spread out a bit until you become more confident.
No, I think if the amount is higher, will you go beyond 2 years? That's what I meant.
Okay. I think the max I'll go is 3 years. So end of the day, you also need this money to work for you.
I see.
Okay, I need this money work for me. I cannot have this money keep only earning like 1% or even lesser. So for this number to all make sense, this money has to work. So I think max is about 3 years. Okay, 3 years, I just divide by 3 lah. Okay, so in fact, okay, I should actually try to, put this money investment as soon as possible. But again, on the other extreme is also bad lah. You cannot say that, oh, tomorrow I will just invest this 200,000. No, cannot. So I would say that, to play safe, so minimum is 1 year divided by 12 and maximum about 3 years. Okay, that kind of range. Okay, hope I answer your question.
I mean, along the way, if like we have more income, we can also under the custom RSP tab, we can also adjust the how much you have for investment now, and then we will have a better gauge. Is it?
Okay, so basically you can see that this number is actually about the same one. So what you actually want is this. So let's say, for example, 5 years later things has changed. You may actually want to redo again. Then
like shorten the number of years really, right?
Correct. Yeah, this number will change, this number will change. So it's actually should be quite dynamic until you probably hit about certain age lah. But you know that you will hit it eventually.
Okay, I understand.
Yeah. So if let's say, for example, you are not married yet, certain expenses are not fixed yet. Yeah, things are still quite fluid. But if you start doing this exercise, eventually you know that even you actually change things, you still can meet.
Okay, understand. Thank you.
Yeah. So end of the day, of course, you go through spreadsheet, you know that the accuracy may not be 100%. Okay, we are probably only talking about 70-80% accuracy. Okay, if you realize. Okay, but then my point here is this: once you have this thinking, you have this process, after that you want to adjust, it actually get very easy. That's the point here. Okay.
Yeah, agree. And I also feel that it's good, like, so next time, like, for example, if I different life goals and everything, at least I know that I always have a template to help me keep track of where I am.
Correct.
I just investing without a goal.
Yes. Yeah. And very good. At least I now know that you were shop lesser in Taobao. I'm very happy. Very happy for you. Okay, great. Any other questions? Okay, if no questions, then I'll just end off. I still have some slides to cover. Maybe I just cover those slides. So this is what we have done. We have done goal setting, asset allocation. Okay, so of course, more for those who are joining us for the first time, okay, that's what the subsequent lesson is about. So the subsequent lesson will be actually looking at all the instruments. So today's lesson, to share about how you allocate among them, okay? Then subsequent lesson, look at all instruments. We'll be next lesson, okay, 1 month later, we'll look at endowments, okay? Okay, like for example, how do you actually choose among the endowments? And actually quite interesting. Okay, this is getting actually quite interesting. Like as per what I mentioned just now, more and more of us probably need to get protected from 55 onwards, rather than wait for 65. So in fact, many of us, especially for now of my age, I'm actually 45, 46 this year. Yeah, I start seeing people getting displaced earlier okay. So no longer we can actually assume that, well, our job can last us to 65. So that's why with endowment 40, 45, yeah, maybe. So with endowment, that's what you can actually plan for. So you can actually get payout at earlier age. Okay, so we actually talk more about next lesson. Then after that, of course, we can also do things like funds. Okay, unit trust RSP. So this will be the fourth lesson. Okay, so whereby when we actually talk about some of all this amount, which is currently what I practice right now. Like some of the unit trusts, I actually do RSP . So in fact now I am about every month I actually put about 200-300 into China fund. Okay, that's what I actually do right now. I'll just follow here. So we actually talk about this, how to choose the fund. how you actually do RSP. Okay, that is one lesson to be going covered in the 4th lesson actually. Okay, so REITs as well. So like for example, for REITs, what I do is actually this thing called dollar cost averaging. Yeah, so you will actually learn how to actually pick out REITs. And to me, for REITs is I just buy monthly. Okay, I just do it on a monthly basis, so that I have the law of large numbers to kick in. Okay, true enough. Like for example, I've done this for some time. I have REITs that make, REITs that lose, but I'm doing about 70%. Okay, 70% of my portfolio now is actually making. For REITs portfolio, 30 is actually not making, but net overall I'm actually making. So that is how we actually go and play this game. Use science to win the money. Okay, choose the right REITs, increase the probability. We just repeat dollar cost averaging, at least for REITs here. Okay, then you'll be the casino in the investment.
I mean, whenever
Yes.
you repurchase your REITs, right, do you buy the same REITs every month? Because if you buy this way, you are paying the commission fee every month, right?
No, I try not to.
Okay.
So every month I will buy different REITs. Okay, I try to avoid buying the same REITs. Okay, so we talk about the REITs one in the REITs lesson, of course. Okay, so of course stocks and ETF, so same thing. Also for stocks and ETF, personally, I don't do dollar cost averaging. Okay, certain month I buy more, certain month I buy less, depend on the market movement. So again, but the concept is actually still the same. I invest regularly. Every month I'll buy. It's just a function of more or less. Okay, and of course, you still have to stick to certain criteria. So this will be discussed in session 3. So milestone tracking, we talk about milestone tracking. And of course, setting up system is as important as making the right investment decision. So this is hopefully the main message you can get back. End of the day, we are not just talking about what to buy. Okay, a quick buy, no. We want to set up the different systems. Okay, like now every month, okay, I have money automatic gyro into unit trust. Every year, my endowment is actually go by year. Every year I have money in endowment, that one automatic. So I actually set up a system. Okay, so my stocks, every month, okay, I will actually buy stocks, just a matter of more or less. So it's like a habit, it's like exercising like that. Okay, and my REITs is every month. That one is dollar cost averaging. So I actually sell this system every month, money coming, pump, go into all these different systems, and it actually keeps snowballing for me. So if you ask me, this is really what investment is about. Okay, not just about what to buy, stock tips on. No. Okay, it's about setting a system.